So with many of these deals in complete and utter jeopardy, would you just stay away from the stocks that are involved? Guess what? The answer, at least with my next guest, is an absolute no. The Pfizer-Allergan deal, which may even be abandoned, is something that Mark Luschini actually likes at the moment, at least one part of it. He's the chief investment strategist at Janney Montgomery Scott. You told us this morning when we were planning this segment, you've got $65 billion in assets under management, so I'm listening to you, Mark. You said, I like Pfizer. I am unfazed by what happens here. The stock is moving higher. What's behind your theory?
Liz, a couple of things. One, the healthcare sector has been one of the poorest performing sectors here to date, which is a bit unusual when you consider the fact that other defensive-oriented sectors like utilities, telecommunications stocks, consumer staples have done well in this kind of rough equity environment we've had so far this year. So, one, it's a beaten-down sector with, I think, pretty attractive valuations. Two, Pfizer is a company that generates high free cash flow, has a pretty good product profile, and in addition to that, sports a 3.9% dividend yield, among the highest of domestic pharmaceutical companies. So that combination to us draws us into finding that as a candidate that's attractive in a sector that we think is poised to begin to outperform regardless of whether the deal with Allergan goes forward or not.
Okay, the deal with Allergan may or may not go forward, and I need to ask this because people are chattering about it on Wall Street, and I wanted to bring it to our viewers. AstraZeneca, 2014. Pfizer had to scuttle a deal with AstraZeneca. It was a $100 billion deal. AstraZeneca is falling now more than 1%. So, I mean, does that indicate forget that deal?
I think that's likely. Obviously, any of these deals that were in some way, form of development and or were speculation that they could develop towards some type of a merger is no longer obviously quite so obvious because of the tax inversion scrutiny that's come under Jack Lew. And so as a consequence, any and all of these deals, even those that have been announced and are preparing to close in some relatively short period of time or longer, have been jeopardized by this new ruling.
All right, we need to take a look at the markets overall. We are now well below the lows, well above the lows of the session at this point, above, you know what I mean. We're now at the lows of the session, down 151 points. And the S&P, by the way, when we got into this hour, the S&P low of the session was down 21. We're now down 23. S&P, the NASDAQ low was down 50. We're now down 52. So we're seeing an acceleration of losses here. Oil, though, is up. Is that sort of oil correlated to stocks trade done now?
Well, I think it's breaking apart a little bit. I mean, obviously, the market was taking its cue from oil prices as they were falling on a seemingly a day-over-day basis. And now that that's been arrested and we've had this rally in oil prices to a level that I think provides a little more stability for oil-producing companies and countries, not necessarily profitable, but at least better than $20 a barrel, I think equity investors have pulled back from using oil as a cue and said, what's happening fundamentally in the equity market? We've had this ricochet rally that now needs to be validated by economic information and earnings, and we're entering an earnings season that's poised to deliver less than stellar results.
Well, that leads me to my final question. We've got about 30 seconds. What happens in the second half of this year?
I think better news for equity prices. I think what we find is that the economic developments that we've seen of recent continue. We see stronger, sturdy economic growth, a more fertile climate for, therefore, corporate profits, and while not spectacular, should be enough to allow this equity market to advance and start to challenge the all-time highs of a year ago.
Your favorite sector for the second half?
Well, it remains defensive at the moment, Liz, and that would be telecommunications and healthcare.
Okay. Great to see you, Mark. Thank you for joining us.
Thank you, Liz.